Hello, everyone, and welcome back to our live sessions. So today we have global forecasting school students here who are going to talk about several topics. In particular, Diana will talk about the measures of non-traded sticky price inflation that were developed by the Global Forecasting School and have already been implemented to a few countries like the US, Armenia, Georgia. Then at the Global Forecasting School, we also developed a chart pack for monitoring economies. Ani is going to talk about one particular chart pack that she has been working on, and that's for monitoring the US economy. And finally, we are going to have Anna, who, as you may remember from yesterday, mentioned that today she is going to speak about the GFS projections, the case A and case B for the US economy. And since today is the day of the release of PCE inflation, we are going to discuss how our projections have changed and what are the implications of this data release it's going to be. And before we start, let me again remind you about our upcoming seminar and upcoming courses. So we are going to have Professor Morris Upstill with us on July 11th. He's going to talk about neutral interest rates, as well as we have already started. We already opened registration for the courses for the summer and for the autumn. So you can find the information on the Better Policy Project website, and you can register there and apply for the course and for the seminar. So now let me pass the floor to Diana.
Hello, everyone. Thank you, Asyakostanyan, for a nice presentation. And of course, we are glad to share our upcoming courses about the Dynar and Python, especially during these days when we are highly we have highly deep use in Python coding during these days. So let me say that, of course, we are in development team and we have different projects during this time. And of course, we have different focuses for several weeks. And for this week, we were mainly concentrated on the inflation part. And as I mentioned, our main concentration was on the non-traded sticky price inflation. Let me say that this index was elaborated in Global Forecasting School with the Better Policy Project. And we identified that this index is the better measure, especially during these high uncertainty times. And we started the calculation for Armenia and Georgia as well, and our colleague Isya calculated it for US. And now we wanted to enhance our work and calculate it for our country cases. Let me say that we don't want just to have some calculations, but for our current analysis and for understanding better what are the underlying pressures and what are the inflation expectations at this moment, and what is the excess demand pressures on the inflation. We started the calculation for our country cases. Let me briefly share this nice presentation with you. And so if you can see my screen, as I mentioned, it's the part of our current analysis because now we have our country cases, which have us opportunity to dive deeper on the different countries and to understand how FPAS and non-FPAS central bank can deal with our new framework, monetary policy framework, FPAS Mark II framework. And as I mentioned, we started for US. So let me say that this better measure of inflation give us much deep information about the ongoing processes in the economy at this point. So we put for US this data with unemployment rate gap to highlight it, the wage inflation spiral that could be. And for these processes, we chooses the non-traded sticky price inflation. Also, we calculated it for Canada. At this point, my focus on the Canada. So let me say that Canada was the first J7 country that reduced the policy rate during this month. And before the May data was released, they communicated that the main underlying inflations had the declining path during last month, which was a good signs for their loosening path for monetary policy. But even they have some cooling signs in labor market, and also GDP growth was less than their projected path. For May data, we received that the non-traded sticky price inflations move its path, and now they had some more momentum change for their non-traded sticky price inflation, which means, of course, that the underlying pressures is still there, and the market expectations can be easily changed. Let me say that for FPAS Mark II framework, this is the important part, because the dark corner of the economy can be at this point is the anchoring of market expectations, and of course it will affect on their credibility as well. So briefly, let me say that we use the non-traded stick price inflation for our daily thinking about the economic developments. And as I mentioned, we want to calculate this measure for our country cases. So Svetlana calculated it for Israel, and you can see that in the end of the lines, also we have this momentum change for Israel case as well. So our colleague Sergey calculated it also for United Kingdom, and you can see that here also non-traded sticky price inflation is much higher than their headline CPI, which is talking about the persistency in services prices, which is also highly correlated with the excess demand pressures. And Ani, who is working on the Brazil case, also calculated non-traded sticky price inflation for Brazil. And here you can see that in Brazil case, it's much below than headline inflation, which is according their tight monetary policy conditions after COVID crisis. So this is just briefly what I wanted to share about our works. And of course, my colleague Svetlana will continue me and will give us a deep insights about the non-traded sticky price inflation, and why it's very important to understand the economic meaning of this measure that we elaborated here. And also let me say that our concentration at this part of our job is also on the chart pack, and even Ani will present it. I wanted to say that it's also a very important tool for us for monitoring our country cases. So we want to develop this chart pack and create a quotes for our country cases, so we can easily monitor the economic developments and to understand what is changed from our last thinking and judgments. So at this point, this is what I wanted to share with you. Thank you for your attention. And Anijan, the floor is yours. You are welcome.
Hi, Mr. Anijan. I would like to share with you why we need these non-traded sticky price inflation measures for each country, why we construct these measures. We have different measures for the CPI inflation. So, and also thanks Dana for introducing the first part of it. So to begin with, we must address a critical question. So how should we decompose the consumer price index to better assist monetary policy makers in making informed decisions and also communicating policy more effectively? So I think that addressing this question allows us to refine our approach to the CPI, which is crucial for enhancing both the execution and also communication of monetary policy. And our focus is on aligning the decomposition of inflation with two key aspects of transmission mechanism. The first thing is the expected short-term interest rate path, and also the second thing is the implications for the exchange rate as well. So the latter aspect is particularly significant when determining the optimal decomposition for various price measures. And also this approach draws on the influential work on Dornbusch, especially his paper Expectation and also Exchange Rate Dynamics, also known as the overshooting sticky price Dornbusch model. So what he introduces in the model. So in the model, the concept of sticky prices and the flexible price counterparts are also important. So the ideas from the backbone of our practical application and analysis within the framework New Open Economic Macroeconomics. And additionally, the contribution of also Maurice Opswild and also Rogov, who developed this new open economic macroeconomics with stronger macro foundation, are integral to our methodology. So their research has also inspired some practical applications like the global economy model developed by the IMF's research department. Also this, we can say that this is bridging the gap between academic theories and also models directly applicable to policy analysis. And our approach leverages these critical insights, selectively employing models based on dynamic optimization theory, depending on the specific question and issues that we wanted to look at deeper. So the traditional sticky price measures such as core median or trimmed median that we have are often treated statistically, focusing on removing the only volatile items without deeply considering the economic rationale behind the categorizing items for analytical clarity. However, in the new open economic macroeconomics provides some robust framework for distinguishing these price categories. So prices that are sensitive to exchange rate fluctuations, we call them flexible. And the another part, those are less sensitive to the exchange rate movements, are called sticky. So this distinction is essential for assessing the effectiveness of short-term interest rates over time. And in the model, in Dornbusch's model, overshooting the sticky price model, the rapid movements of asset market construct with the more sluggish segments of goods market, which leads exchange rate overshooting dynamics. So internationally traded goods directly affected by exchange rate movements, exchange rate changes, and they are classified as flexible prices, while non-traded items such as mostly services fall under sticky prices. And although the exchange rate is influenced by monetary policy, it is not a direct target for central banks, but Instead, we can say that it reflects a combination of economic factors, which includes policy rate decision and market expectations as well. And distinguishing between traded and non-traded goods prices are also important here. And the sticky prices respond more slowly to market changes than flexible prices. And offering some unique insight into inflation dynamics and also inflation expectations. Conversely, the flexible prices are, we can say, subject to some idiosyncratic shocks and can adjust quickly to market conditions. Also, we know that central banks typically employ the various measures of core prices, and each targeting specific aspects for consumer basket and also offering different insights for analyzing price trends. And when I look at the Israel's data, so they have the headline CPI and also they offer different types of core inflation measures. So for example, they have the excluded only the energy, excluded both energy and food, and also they have energy, food, some fruits, vegetables, and etc. So they offer different types of core CPI measures. So, the use of these diverse inflation measures is integral to comprehensive policymaking and also analytical framework. And what's the motivation behind this? Why we decided in Global Forecasting School and the Central Bank of Armenia to have a measure for this non-traded sticky price inflation. So the motivation for developing a measure for non-traded sticky price inflation arises from the specific challenges faced by small open economies, especially during periods of some great volatility and also uncertainty periods, for example, COVID, and also some geopolitical events that create some geopolitical uncertainty. And the objective here is not to merely provide another alternative measure of underlying inflation, but to address the need for early warning signals where inflation expectations could become de-anchored. And therefore, the proposed measure should clearly reflect the underlying long-term driving forces of inflation, which also allows central banks to monitor and also quickly adjust policy to achieve some macroeconomic and price stabilization. The traded goods prices also can be affected by some wide range of external factors such as fluctuation in exchange rates, changes in global supply and demand, and also disruption to global supply chains. So many of these price movements stem for factors that are either temporary or beyond the scope of monetary policy and should not receive a policy response for monetary authorities on the period by period basis. So the situation was evident during the COVID-19 pandemic when disruptions like changes in trade policies. Also, there was some transportation restrictions and also shifts in consumer behavior. There was also some supply chain issues and labor shortages, which created significant bottlenecks in production and also in supply chains. And these bottlenecks directly impacted the prices of traded goods, which we can say lead to some significant short-term increases. And for example, the US case when the furniture prices as a durable traded goods were affected by supply chains disruption during this period. So during the COVID-19 pandemic, so we see some increased demand due to stay-at-home orders and changes in consumer spending habits. And we can say that it's increased about the 24% from April 2020 to April 2022. And these price shifts were driven by a series of transitory supply shocks rather than some fundamental fundamental changes to longer-term supply and demand dynamics. So, and also, as we are now in the FPAS Mark II framework, and the Central Bank of Armenia also is in the FPAS Mark II framework. And also we know that to effectively utilize the concept of sticky and flexible prices, we must align with our broader understanding of monetary policy's influence on the economy. And in FPAS Mark II, we know that there are three main and essential questions that we this alignment helps us to address the three fundamental questions that are effectively analyze the economy. So the first is what is the current state of the economy, what are the underlying forces, and what instruments we need to achieve our goals. So these actions and these three questions help us with transparent communication about the future policy adjustment, directly influence market interest rates and exchange rates. So I think that this is the part that I wanted to mention from the non-traded sticky price inflation measures. And I think my colleague Annie will continue about the chart pack. So thank you. And Annie, the floor is yours.
Thank you, Svetlana Jan. Hi, everyone. I'm Ani from Central Bank of Armenia and student at the Global Forecasting School. As Svetlana has already mentioned, I will continue by some technical stuff. So particularly, I will introduce you to the tool to Python that help us create economic figures and data, and also it provide data analysis. So actually, as it is open source and very user friendly, Python is a very powerful tool for economic analysis due to its flexibility and also its libraries and capabilities for data manipulation and statistical analysis. So let me just briefly talk about it, and then I will move on and we'll talk a little about what we have created as the non-traded sticky prices. This is an example of a code that we have created together with Asya and Vahagan, and we have done this to monitor the main variables of the US economy, which is included in the chart pack. So basically, chart pack is a comprehensive analysis that provides the full picture of the economy, and we are allowed to see both figures and tables and to get the whole story. And right now we are trying to develop such codes for chart pack for different countries as well. For example, I am doing research on Brazil, and later on I will move on and I will analyze Turkey's economy as well. Svetlana is doing her research on Israel, and Diana is doing her research on EU. The code, I won't delve deep technically into the code, but I will just mention some of the tricks that we use to generate these chart pack graphs and tables. And for that, basically we import data from Fred for the US economy, and but we don't restrict ourselves just by phrase data, and also go on and analyze and find data from other sources as well. And for that, we can also import data from just an Excel file and so on. These are the libraries that help us to create the figures and do procedures. We also add recession data that allows us to see the recession periods in the graphs by shading areas. And Then we import the data, and by basically using the built-in Python functions, or just by manually creating formulas, we can then calculate the growth rates of the series, such as month-on-month annualized, or 3 months over 3 months annualized growth rates. And so after calculating this and setting our data, we can move on and create such graphs, such beautiful graphs. So these are the graphs that we have created for the US economy, and right now we are working on developing the codes for other economies as well. For example, I can show you here briefly about the Brazil's case, which is still in the progress. And so this is basically what I wanted to share for the Python related stuff. And as for the non-traded sticky prices, I want to talk about a little why in general we want to consider these so-called non-traded sticky prices, and why it is important for us. So basically, these non-traded sticky prices, they refer to, as Svetlana has already mentioned, and I want to note that again, that it refers to the prices of goods and services which do not easily change their values and are not easily traded internationally. And since these prices move very slowly and they adjust very slowly, they can provide actual very valuable insights to the underlying and persistent inflation trends, rather than these short-term volatility. So we can consider that non-traded sticky prices play very crucial role in shaping the underlying inflation by contributing to its persistence and so on. And in doing our research and also in doing policy making, policymakers need to consider the behavior of these prices when they do their policy analysis and do decision making. So to construct this measure of non-traded sticky prices, we how in general we should construct it. We actually plan to construct these sticky prices for different countries. As Diana has already mentioned, some of them are already ready, and we are working on others as well. And for that, we to construct these prices, we use categories, separate categories that are provided by their central banks. And so we need to, firstly, we need to identify which of these categories belong to non-traded goods and services, and which of them do not fall into these categories. And then we, after that, when we try to pick and try to select those non-traded goods and services, then we assess their price stickiness. So how often they change their prices, basically. So we identify these non-traded categories and determine which of the given categories are typically considered the non-traded. Generally, those are the services that are that are generally those are considered the services. And also there can be also some goods that are locally consumed, and these goods also fall into this categories. And so for that, I want to share with you the process and how I have calculated the non-traded sticky prices for Brazil's case. Let me share my screen. So these are the categories that I was talking about. Here I have several ones, including food and beverages, housing, domestic goods, clothing, transport, communication, health and personal care, personal expenditure, education. And as you can see from the coloring, the green ones fall into the non-tradable category, and the blue ones are the tradables, and there is also one category that is disputable. This is the transport, and it does not include the issue is that I am not certain if it includes the fuel prices or not, and so that's why I have it as a disputable category. And so I have categorized them as tradables and non-tradables, as you can see. And by selecting the out of these the non-tradables, then I moved on and tried to analyze what volatility these series have. So sorry. So yeah, this actually the last three ones, health and personal care, personal expenditure, and education, are basically the least volatile series. And for that, I have constructed three versions for these non-tradable sticky price measures. The first group include these least volatile categories that I have already mentioned. Those are the health and personal care, personal expenditure, and education. The other one also includes housing, which is slightly more volatile than the other three ones. And the third one also includes communication as well. As Diana has showed us, this is the Brazil's non-tradable sticky price version. And I have compared it with the headline inflation. And as you can see, the headline inflation, it has more volatility compared to non-traded sticky price measure. Here I have two versions of non-tradable sticky prices, and you can see that in both of these series fall below the target, which is 3% for now, while we can see that this headline inflation is still above the target, and still it needs to decrease over time. If we look at the Brazil's central bank's monetary policy decisions, we can see that they have conducted a tight monetary policy for after COVID pandemic for about more than 2 years. So these extended period of tightening, they believe that this tightening for an extended period has had its consequence on the underlying inflationary measures and inflation expectations as well. And they have, after this extended tightening, they have started to shift to monetary policy easing, and recently they have updated their decision by decreasing the policy rate from 10.75% to 10.5%, and they plan to decrease further by reaching 10% in July 2024. And so they believe that although this headline inflation is still volatile, and although it is still above the target, but looking at the sticky prices, non-tradable sticky prices, which has its reflection on the underlying core measure of inflation, and also looking at the inflation expectations, we can see that this tight policy that they have done after COVID actually has its delayed impact on the inflation. So they believe that it will continue to be so, and they start to shift to monetary policy easing from now on. So this is what I wanted to share with you about Brazil's economy, about the about constructing non-tradable sticky price measures, and also some technical stuff about Python code. That's it. Thank you so much.
Thank you, Anjan, and thank you, Diana and Svetlana, as well, for your interesting presentation on non-traded sticky price inflation. I believe that under FPAS framework, like Diana has started this presentation very well, that why do we need this non-traded sticky price inflation measure alongside while we already have a couple of different inflation measures already. However, under FPAS central bank, as an FPAS central bank, we answer this key fundamental three questions, and I will be also sharing my screen here as well. 1 second. So we have these three fundamental questions. Where is the economy now? What are the underlying forces? And how should policymaker use its policy instruments to get to the target? And under this second question, which is what are the underlying forces and what do we think might be driving inflation, this not traded sticky price inflation is exactly where it comes into play. And by this measure, we have more information as a policymaker, such as we from flexible price inflation measure, we can have this sort of early warning signals where the inflation could become de-anchored, while sticky price inflation measure provides us a better insights of the inflation expectations by the market participants. And that is exactly where why in FPAS Mark 1 as well as FPAS Mark 2 framework, we need this measure, and this measure is very crucial to understand better these underlying forces. So now I will be continuing our presentation from the on the US case A and case B. I would like to.
Sorry, Anna, your screen is not, you haven't shared.
Yes, it's not sharing. It's telling me share, like I usually share perfectly. Share to main session only, and it shows me like entire screen. Okay, maybe what I will do is just, okay, you can see now, right?
Yes. Perfect.
Yes. Okay. So, and moving from non-traded sticky price inflation measure, which is very important. Now, let me continue our presentation from case A and case B scenarios. At Global Forecasting School, we apply FPAS Mark II framework to different central banks and look at everything from different countries. And these different countries, I personally have appointed Czech Republic, while Sergey has UK, and etc. But we all have this US economy as a common country, because based on this US economy, we sort of analyze US economy, because it's very important to analyze US economy for many reasons, because it affects these sort of developing countries, like our case studies countries, very majorly, as well as our countries like Georgia, Armenia, and these sort of developing countries. Due to its, for example, for us, we have highly dollarized countries, and
for many other reasons, it's important to analyze U.S. economy. So under FPAS Mark II philosophy, at the very first starting point, we start analyzing, therefore, U.S. economy due to its size and its huge spillovers all over the world. So that's why it's very important to start from the U.S. and under FPAS Mark II perspectives. And with the starting point, we may look at the balance sheet first of all, and in this presentation I will have some updated data on GDP now estimate as well. So if you look on the left hand side, the economic activity, we will clearly see that economy appears to be solid. From the US economic activity, for example, in the first quarter of 2024, we see that real GDP stood at 1.6% on year-over-year basis. And in general, over the last several quarters, we have not seen any recession or any downturn, right, in the US economy. So to answer what we are going to expect in the second quarter, we will see that even in the second quarter, based on updated projections of the Atlanta Fed, we should still expect solid economic activity will remain there. And in the second quarter, the data stood at 3%. And now I want to show you the updated sort of data on the GDP now estimate. So as of June 27, so yesterday, with the latest estimate, GDP now currently stands at 2.7%, meaning that this is down from 3% on June 20. At Global Forecasting School, we don't just analyze the number, but we need to sort of have this story. And the story behind this 2.7% GDP now estimate, which Atlanta Fed provided, is that we are this 2.7% down from 3% is sort of our case B type of sort of scenario. However, it's still is still sort of elevated for our case A scenario as well. So I will just say that roughly it has moderated from 3% to 2.7%. However, it still remains elevated compared to the US neutral rate. And regarding this neutral rate, I will be discussing a bit more later in today's seminar. However, I would like to mention here that in the US, as well as many other central banks and many other economists, there is an uncertainty going on around what is the neutral rate. Has it been shifted upwards due to some technological advancements, due to this AI improvements, and many other reasons? So it's sort of remains uncertain with this current environment. And this neutral rate, we may think, is high in the US, and Fed will struggle to keep interest rates for longer terms at low levels. And these fundamental factors, including fiscal related issues, this AI development in IT sector, may lead us to think that neutral rate could have been shifted upwards. And it is higher than what currently maybe Fed communicates. So continuing with the GDP now estimate. So in the second quarter data, it stands at 2.7% with the updated newest data. And key question is now that why is it solid? Because for the US, 2.7% GDP growth, I will say still solid. And to directly answer this question, answer would be consumption. And if we look at the dynamics of the real personal consumption expenditure, we realize that after 2021, people just started spending their money. And on the right-hand side, we see this consumption, and we see that service consumption contributes the most, especially, which remains solid, and it's kind of rational, to be honest, in the case of US, and not only in the case of US, but also if we see dynamics of various other countries. And as I said, we are central bank watchers, and so service consumption in many other countries, such as, for example, Czech Republic, as well as the US, as well as the countries you mentioned, for example, Canada as well, Diana has mentioned. So this consumption service consumption remains still elevated and higher than the target. So meaning that after pandemic related restrictions, maybe people have this accumulated savings and follow this sort of revenge spending. So that's why we may see this service consumption being so strong in the US. So in other countries as well. So this can be also seen from GDP now estimates, and as mentioned with the latest data, it is 2.7%. And despite the service consumption being a key driver, we don't see also big moderation in goods consumption either, especially in durable goods, which still remains pretty strong. So this strong consumption driving story is basically starts with the U.S. household balance sheets, and that's why we analyze U.S. household balance sheet. If we compare the end of 2023 to the beginning of 2021, we see total U.S. net wealth increased by approximately 50 trillion. And this is a huge number. It's more than the US GDP number of 2019. And solid balance sheet of the US was primarily driven by massive accumulation in both financial as well as non-financial wealth. And under financial wealth, while we mean stock market, what happened at the stock market. Under non-financial wealth, we mean like a real estate sector, which both have been increased. And basically, you see at this graph that at the beginning of the pandemic, there was a slight drop in the stock market, but then it started to accumulate. Firstly, it was just reinforced by easy monetary policy. But despite this, once Fed started to tighten its policy in 2022, this tightening policy, at first we saw some correction at the stock market, and in the latest numbers, we clearly see that asset prices peaked its maximum over the last year. So this massive asset price basically got translated into accumulated financial wealth by US household, and this sort of increased the net wealth. And also this non-financial side, like such as real estate, houses prices significantly increased, and this also got translated into accumulation of non-financial wealth. So in the end, this total accumulation in non-financial as well as financial wealth is directly does not impact consumption, but it creates this sort of buffer for the US consumers to feel confident to keep spending money. And since we don't have given dynamic in this since given dynamics in asset prices, household balance sheets is still solid, which we see from these graphs. And what's happening in US economic activity is sort of exactly reflected also in the sticky price measure. And this sticky price measure, my colleagues has been discussing, is very important inflation measure under FPAS Mark II framework. We don't have updated recent data, unfortunately, on that. I will show you as well that with the latest data we have is from May. However, we are soon expecting to have updated June data as well. So from the graph, we see that it's the sticky price inflation is still elevated, and recent 3-month over 3-month inflation declines, but is still around 4%, which is higher than 2% US target. And these demand side pressures, and especially the solid consumption in service sector, hinders underlying inflationary pressures. And we know that this service consumption exactly draws the sticky price inflation. And as mentioned, this 2.7% now cost of GDP now is above CBO estimate of, for example, potential growth, which stands at 1.8%. And this just leads us to think that demand side pressures will be serious challenge for the Fed to moderate. And that's why we see this Fed still maintaining the higher policy for longer period. But the key question for our as a GFS students is that, is this policy stance enough to moderate this highly increased demand side inflationary forces? And so just because this GDP now estimate declined from 3% to 2.7% for the Q2 of 2024, to answer this question, is this policy stance enough? We may say that it is enough to maybe moderate, but at a slow pace. And but it's still sort of very uncertain, and 2.7% is still higher than this 1.8% CBO estimate. So if we just look at the Fed's communication, that the long-term rate will stand at around 2.5 to 3%, then we may say that maybe there is some just lagging issues in monetary policy transmission mechanism, and after this lags, it will eventually moderate, and maybe in the later stages we will see some deceleration in demand side pressures. However, everything is uncertain, and that's why we are trying to think about this. Additionally, very important is that during a pandemic, there was this increased sort of savings because everything was sort of limited to spend money and etc. So that sort of pent up demand got translated into these accumulated savings, which then also got translated into an increased wealth of financial as well as non-financial. And up until now, I was talking about demand side pressures in case of inflation of the US, and this case A type of scenario. Demand side story is very interesting, but from the supply side, particularly, story becomes also very interesting. And uncertain recently in case of labor market, because labor market currently sends very uncertain messages. Labor market sends some messages that support our case A scenario and some messages that support our case B scenario as well. So moving on to the labor market analysis, if we look at the beverage curve, which shows us the relationship between the vacancy rate in the US and unemployment rate, we see that it shifts inward. It started to shift inwards, definitely. And this means that unemployment, this tightness at the labor market more or less eased. And however, if we look at the wage dynamics, we can say that wage growth still remains high, and the growth of the average hourly earnings exceeds the CPI inflation. And we see that the wage price spiral risk is still there. So dynamics of the financial conditions are very important to analyze as well, because these conditions are currently pretty restrictive, meaning that it moderates these demand side pressures, and this decrease from 3% to 2.7% could be maybe due to this tightened financial conditions. If we look into the decomposition, we see financial conditions are pretty tight in case of business and consumer loans, which results in moderation of consumer and real estate loans, and increased interest rate also helps this moderation. And that's why we see the downward dynamics in case of loans in the US, which leads us to think that if it continues, then it will somehow just ease these demand side pressures, and the analysis of financial conditions more or less fits our case B perspective under FPAS Mark II framework. And in this case B, what we may just be observing is that this tightened financial conditions will sort of decrease this demand side pressures, and under case B, we will be just observing lower inflation and faster moderation. Under FPAS Mark II, reference point is very important. What market thinks is crucial, and why? Because the expected path of the policy rate is an important as it affects longer term interest rates. So if you look at the market probability tracker of the Atlanta Fed, we'll see clearly that market participants has revised up their longer term interest rate expectations, which may lead us think that long term rates will remain high, and maybe neutral rate is also higher, as we mentioned, higher than what Fed communicates. So now let me, as a final note, briefly analyze our case A and case B scenarios, starting with case A. Given that there are these demand side pressures, we think that the strong demand may persist, and the strong demand will be exactly followed by the solid household balance sheet. And if we don't see a moderation in asset prices, which can be validated by higher neutral rate currently, we may still stick to this case A scenario, because high asset prices will ultimately be translated into the solid household balance sheet and will fuel consumption. Additionally, as mentioned, wage growth dynamics also leads us to think that labor market remains tight. But in case B scenario, we can think that in tight financial conditions, we will just impact these demand side pressures, and soon we will be observing moderation in economic activity. And we are seeing a rate of several loans are increasing, and this means that financial markets are sort of pricing risks, and recently we are seeing rates of several loans increasing. Financial conditions may be further tightened because as the risk appetite of the commercial banks further decrease, and this will be ultimately translated into lower credits and ultimately lower consumption. And with the new recent data as well for CPI and core CPI compared to the last estimates. So, for example, we have updated data for PCE, not yet for CPI, but from the inflation month over month recent change from the PCE, we see that compared to May, it has increased slightly, while core PCE has also increased slightly, and the data has also been updated yesterday with the GDP now estimate. And year over year change, we also see this sort of little increase in core PCE. However, we for the PCE, we are observing a little decrease from the past month from May. And with this new updated data on PCE and core PCE, so core being increased slightly while PCE decreased slightly, we don't see a major change in this inflation measures, and that is why we can just sort of assume that it's a global forecasting school, as students still follow this case A type of scenario. However, we also have some things supporting case B scenario as well, such as this labor market slightly indicates that maybe we'll see some moderation from supply side pressure. So based on all this, we think that under case A scenario, Fed funds rate will increase slightly or stay at current level for longer period. And under case A, we say that strong economic activity remains longer, and it may turn into higher real rates because investors will demand higher real rate for longer period. So also in case A, unemployment rate will go down in short term, because in the short term we will still have this generalized excess demand conditions, and later it will just moderate and go up to the 4.2%, which is in line with CBO's estimate. So thank you so much for today's presentation. Again, Diana, as well as Svetlana and Ani, and we will maybe just end our presentation here. It's exactly 6, right on time. Thank you, and I would just like to mention that stay tuned. We have seminars every day at 5 o'clock, and we will be updating our data, and it's very interesting time. It's end of month and it's end of quarter, and we will have more updated data in the next week. Thank you.
Thank you, Anajan, for this great presentation.